presentation. I really didn't modify it much that we've given to cities and towns, but there are changes in the annual financial report for next year, and there will be changes for the following year, so I want you to be aware of those, and that is what we are going over now. If you go to our website, you can find our mission statement. I think we keep trying to emphasize exactly what we're trying to do here with our audits and with our audit reports. So there's some information on that. Okay, for an overview, currently, unless you are producing Gaap financial statements, so we pull you kind of aside, but for most of the counties, your financial statements are presented on a regulatory basis of accounting. That is the system that was prescribed by the state examiner. You're doing what we told you to do. According to statute, the state examiner gets to do that, prescribe the accounting and reporting systems to be used by governmental units in Indiana. So we have statutory authority to do that, and if you're new, you won't remember. If you've been around a while, we used to do Gaap financial statements, and we went to the regulatory simply to be more efficient in our time and to do more compliance auditing that we needed to do. The main difference between the regulatory basis of accounting and Gaap basis So regulatory, as I said, is prescribed by the state examiner, so it's really only in Indiana. Okay. Gaap financial statements, that's a national body that determines how those financial statements are supposed to look, so that is going to be consistent throughout the United States. So there's a difference there. Your regulatory is on a cash basis, which means we recognize revenues when the cash is received, and we recognize disbursements when the cash is paid out. Gaap is on an accrual basis, where we try to match both revenue and expenses with when the actual goods are received, services are performed. In a Gaap report, your financial statement notes are a lot more extensive, a lot more detailed. So Indiana local governmental units will remain on a regulatory basis. Okay, so that part's going to stay the same unless they are required by statute to have Gaap basis reporting. Under Indiana Code 5-1-11-5.4, which we talked about last year, a county with a population of over 100,000 who are planning to issue debt in 2020 or beyond are required to prepare Gaap financial statements for the year preceding the year they intend to issue debt. Do keep in mind, 2020 is a census year. Don't know if it'll change, but keep that in mind. So if you are familiar with Gaap, you know that it is a set of accounting rules and standards for financial reporting. Okay, it's the rules and the standards that we follow to produce financial statements so that they are consistent, so that the reader can understand it, so they can make informed decisions. Okay. It is a standardized reporting framework that is used by bond and rating companies, banks, citizens, and other readers, even outside the state. The purpose of Gaap is to ensure that financial reporting is transparent and consistent from one unit to another. So we said, like in regulatory, you compare one county to another and get some idea. But if you were going to pull a county in California and try to compare their report to ours, they're on Gaap, we're not, it's not going to be as comparable. Obviously, Gaap has been a hot topic in our legislature for a few years now, and they did change the statute so that some counties, for cities and towns, if their population is over 75,000, they also have to produce Gaap financial statements if they're going to issue debt. And for schools, and I don't remember, I apologize what the ADM is, but they have a certain size that they are going to have to as well. So for governments, GAAP is set. Who decides what GAAP is? GAAP is set by the Government Accounting Standards Board. You hear it called GASB. The framework for the financial statements that are considered GAAP is GASB 34. If you were around back in 2009, a lot of people were talking about that. It was set back in 2009. GAAP reporting is based on generally accepted accounting principles, which are accepted in the United States of America. This standardizes reports so that the readers may more easily identify and compare reports. We talked about that. So GAAP is the framework and the rules. Basis of accounting refers to when the revenues, expenditures, the expenses, the transfers are recognized in the accounts and reported in the financial statements. So specifically, it's referring to the timing of the measurements made. In the accrual basis, most transactions are recorded when they occur, regardless of when cash is received or dispersed. So revenues are recognized when the good has been given or when the service has been performed, and expenditures are recorded when the good has been received or the service has been provided, even if you're still billing and waiting to collect the cash on that. In the cash basis, on the other hand, you don't recognize it till you actually get the money in as a receipt or it going out as a disbursement. Then you add fund accounting into this. So a fund is a fiscal and accounting entity with a self-balancing set of accounts. Funds can be reported on an accrual basis. They can be reported on a cash basis. So either way, so that's a different framework again. Your funds are maintained and reported on a cash basis under the regulatory. So we're going to be talking about capital assets in a minute, so I thought, to me, that was always an easier way to understand the timing. So let's say your county purchases a dump truck. I would be ignorant here because I don't know how much those things cost, but let's say it costs $50,000 to get this wonderful piece of dump truck. Under the cash basis, you're going to expense that entire $50,000 when you purchase that dump truck and you pay that payment out. Under GAAP, that dump truck is going to last more than a year. So you want to allocate the cost of that over the life of the purchase so that you are taking the expense and matching it up to when it's being used. So if 1/10 of his life is used in the first year, you only show 1/10 of the expense. So that goes, so we'll get into that later, but that goes into with depreciation. But instead of putting the whole amount in the first year, you're kind of spreading it over the life of that. The receivables for counties, and you probably realize you don't have a whole lot of those. I think the most common one I run into is your EMS. If you have EMS runs, they owe that money at the time they do the run. As you know, billing and getting insurance payments is going to take a period of time, so it sets up a receivable. They owe you that money. And so that's where the services have been provided. If under a GAAP, you would recognize it at the time, even though the money hasn't actually received you. Under a cash basis, you're still going to bill for it, but you're not going to recognize it until they actually make that payment. Modified accrual is a modification of the accrual basis. GAAP does require that for certain statements, so it's kind of a hybrid. Basically, the regulatory reports that you compile each year are considered an other comprehensive basis of accounting, or OCBOA, if you hear that term, because it is regulatory that's prescribed by the state examiner. Here's the statute I was referring to earlier, where if your population is greater than 100,000 and you are going to issue bonds after June 30th, 2020, you have to produce GAAP financial statements for the year prior to the year you're going to issue those bonds. So we do get questions on it. It is both of these. In the current statute, doesn't mean it's going to change, but under current law, both have to occur. You have to be more than 100,000 and you have to be planning to issue debt. But the sooner you get started as far on the GAAP, We certainly encourage you to do that if you know. I mean, if you're a fortunate county that you will never have to issue debt, I guess I wouldn't worry about it, but I don't know how many are in that position. Okay. There is currently a law, and the code is on here. You have always had the ability to request a Gaap audit, so if you want to produce Gaap financial statements and you wanted us to audit them, we will do so. Don't all jump at once, but we're up there. Whoops. Okay. If you want to do that, it does require a resolution by your legislative body, and then you have to go through an approval process with our office. And that is all out in that, it's in that statute, so you can go out and see that if that's something you are interested in. Okay, here is the email if you want to start doing Gaap reports, and you're not required to yet. This is the email you use to make that request. Okay. So that's a brief overview of Gaap. As we've noticed that really there are counties that currently issue Gaap financial statements. There are some more that are going to have to, about 17 counties, that if they issue debt are going to have to produce Gaap financial statements. So what about the rest of us? So as we stated earlier, the state examiner prescribes the regulatory basis of reporting for all Indiana local government units. He has been watching this move toward Gaap for some units and has taken into consideration the requests of financial statement users such as legislators, taxpayers, ratepayers, bond rating agencies, bonding companies. He gets a lot of information that way. And after considering the needs of the financial statement users and practical considerations for implementation in your offices, the board has decided to update the regulatory reporting format. So there's going to be changes. That's what we're going to talk about. Many of these updates pull in elements of Gaap to provide a more consistent reporting framework that provides more accountability and transparency. As we go through this discussion, you'll see that there are notes to the financial statements that have been added. As I talked earlier, before, under your regulatory, the notes were very consistent, pretty much set for you. We have also moved information that was previously unaudited to an audited note disclosure. We will also be changing the financial statement presentation. Some of these changes are going to require more information from you, and some will require more work on your part. But together, it should produce a consistent framework that is meaningful for today's financial statement users. So the end result, we're hoping, is going to be worth it. So what we're going to do today is go over the updates for 2019, kind of a high overview. And as we go along, we're going to have more training maybe in the fall to work on some of the details, because it is a lot of information, so bear with me. As we work through these changes, what we're going to do is start with how the information is currently being reported, and then show you how the information is going to be updated. Some of these changes are going to be put through Gateway when you do your AFR, so we're going to take a look at that. Okay. We do have a table, and I'll show it to you at the end. If I get out and get back in, it's going to even take longer, but I'll show you at the end, and we're going to post it on the website. It's a really good table that shows how we're currently doing, what the changes for 2019 are, and what the changes for 2020 are. It's not going to make much sense now, but after we go through this, it's a good summary, and then they're in the process, again, of getting it posted on the website for all of our units. Some of this information, again, is going to show up in additions to the notes to the financial statements. So our approach is we're going to go through how the information is currently being reported, then show you how the information is going to be updated. So we're going to look at the gateway changes. The first thing we're going to look at is long-term debt. So when you get into Gateway, you have the unit questions that start the process of putting your financial statements on Gateway. In the unit questions for the AFR, you were asked 2 questions related to debt. Does your unit have any outstanding debt, yes or no? If you answered yes, then a debt schedule was generated for you to complete in the annual financial report. And then that's the question on there. This is what the schedule looked like in 2018. So note that we're showing the debt classification, the description or purpose of the debt, the ending principal balance, and the principal and interest due in the following year. Those were all pieces that we asked you to put in if you answered yes, you had debt. And what that generated was a schedule which was included in the audit report as an unaudited supplementary information. So we did not put an opinion on it, but we did provide that information as a supplemental information. This is kind of what it looks like in the audit report. So if you had debt, you would have had this section in there. Again, it shows the ending principal balance, the principal and interest due within 1 year by activity and class. It was not in the notes to the financial statements. It was in a separate supplemental section. When you would go to your independent auditor's report, we talked about several times over the last 2 days, it would say, our audit was conducted for the purpose of forming an opinion on the county's financial statement, the combining schedule of receipts, disbursements, and cash and investment balances under the regulatory basis, the schedule of payables and receivables, the schedule of leases and debt, and the schedule of capital assets as listed in the table of contents are presented for additional analysis and are not required parts of the financial statement. They have not been subjected to the auditing procedures applied by us in the audit of the financial statement, and accordingly, we express no opinion on them. So we are telling the reader, this is additional information, use it in your analysis, but these are not audited numbers. And this was the start of that supplementary information. So if you hopefully have all read your audit report, you had this section that talked about other information that was unaudited, and then the schedules would fall behind that, starting with the combining schedule, and then those receivables, the schedules of debt, and the capital assets. Okay? And bear in mind, we have disclaimed any opinion on these schedules. We just included them based on the information you provided. I just talked about that. For 2019 financial statements, and we're talking about the regulatory basis, which is the information you will be entering into the Gateway AFR by February 29th, it's a leap year, in 2020. The debt information will now be presented in an audited note to the financial statements, which is a big change. We're putting an audit opinion on that, because in the past years, this information was not subjected to audit procedures, and it now will be. There will be 2 sections to this note. The first will be titled Changes in Long-Term Debt, which will show the beginning balance, additions, reductions, and ending balance for each debt classification, whether it's the GO bond or a revenue bond or a TIF bond. It will also show the principal and interest due within 1 year. As you saw in the last slide, you were already providing that information. The second section of the note will be titled Debt Service Requirement to Maturity. It will show the principal and interest due in increments until maturity, which is basically from your amortization schedule that's contained in your debt instrument. So I know what you're thinking right now. Where is this information going to come from, and how much more work is it going to be for me to do? So first, you do enter much of this information through DLGF's debt management report, especially those debt service requirements to maturity. Our office is working with DLGF and IBRC to capture that information and automatically put it in the audited debt note to the financial statements so that you do not have to re-enter it again. Okay? We're going to get what you've already put and pull it in to our side, from DLGF's side into our side for the audited note. You need to make sure that what you've entered in that debt management is correct. That's what we will be auditing. In the debt management report, you're already entering each major class of long-term liabilities separated into governmental and enterprise. Counties don't usually have enterprise. The portion of each debt type due within 1 year and your amortization schedule. And it is very, very important now. It was important before, but we're adding emphasis that you keep it updated and that it is current, that it is correct, because that's what we're pulling over into your audit, into your financial statements to be audited. There's some new information that you are going to have to put in, and this is what it's going to look like in Gateway for the 2019 AFR. This is what you're going to be entering next year. The white columns are the same as they've always been. The blue columns have been added. So you're just like before, you're entering the debt class, the description or purpose of the debt, the ending principal balance, and when it is, and the principal and interest due in 1 year. In 2019, you will also add the beginning principal balance, which was the original issue. Once you've entered that, it will roll over. Again, even with all of that, make sure you're double checking to make sure it's correct. You need to add any additions, which probably aren't going to be real common, but if you have new bond proceeds within that bond, new bonds will have to be added. That's another line. Okay, this information should tie back to your financial records. So your bond issue documents, your bank statements, where this information went. You will need to enter any reductions, which is the principal and interest payments that you have made during the year on those particular bonds or other long-term debt. The ending principal balance then will automatically calculate for you. But again, just like with everything else, look at it, make sure it ties back, that the information has been loaded in, so it needs to be reviewed and make sure that this information is accurate. So there's going to be a new note in the notes to the financial statement. It's going to look like this. It will be generated from the information you have in Gateway. So that, again, just like other things, there's a macro that will run that will produce this. This is the first half that we talked about. And it's just taking that same information from Gateway, putting it in a note format. It's just reformatting. It's not changing anything. This is the second part, debt service requirements to maturity. So this is going to combine the information you've submitted and the information we pull over from DLGF's debt management application to produce this schedule. So you should not have to do anything differently than what you're already doing, other than to make sure that that amortization schedule and the debt information is current and accurate. And this new note to the financial statement will provide much needed audited information to your financial statement users. This is one of the things that they have been asking for. Okay. Here's a checklist that you can have with the information you need to gather. Start gathering up now so you'll have it ready next year when you're ready to do your annual report. So you need to identify your long-term debt by major classification. Again, is it a GO bond? Is it a revenue bond? Is it a TIF bond? Something else pledged for that? Identify each major class by activity. Determine the beginning balance of each debt class. Determine the additions and deletions. If you had any new debt, what did you get? All of your debt payments, principal and interest that you've paid on these. Figure out what's going to be due within the next year, so what's going to be due in 2020. Make sure your debt management report has been completed and is updated. Okay, when we come into audit, we are auditing this information now. We're not just saying this is what you've said it is. We are actually going to audit and make sure that it is materially correct. So that here's an information that we are going to need for that. Our field examiners are going to be asking in order to make that audit determination. We're going to be looking at bond ordinances, debt instruments with amortization schedules, ledger balances, activity for each bond fund, bank reconciliations, claims and supporting documentation for your payments, internal controls over your financial transactions and reporting for debt. In order for us to place an opinion on that note, that new debt note, we have to have the review. We have to review the supporting information, make sure the numbers are correct. There may be additional information they ask for depending on the particular debt, but this is the basic information they're going to need each time. So try to have this information available. Make sure, again, if you have some kind of unique ones like SRF loans that you might have with a different bank, all of that information is available. Your claims, where you made your debt payments, those claims were approved, any supporting documentation that went with those. And I cannot emphasize enough because it's me. Internal controls over your financial transactions and reporting apply to this information as well. So we want to look at what procedures do you have in place to make sure your debt payments are made, that your information is accurate, that what's being pulled into that note is correct. So all the things we've talked about, what procedures do you have in place to make sure that information in your debt management report that you did on DLGF is accurate? Have you traced this back to your actual documents, your amortization schedules, so that you are telling us, because those notes will be part of the packet that comes to you, not this year, of course, but when we're doing 2019, that's going to be part of the information you're going to get. And that 13 we talked about earlier that says, yes, this information is correct, it's going to be part of that. Okay. So there will also be a note in the financial statements, and audited, on leases. So again, we go back to the beginning, and you're doing your unit questions on the AFR. So there were two questions. First one was on debt. The second question was, does your unit have any outstanding leases? So if you answer yes, we do, then you're going to have a schedule to complete. For 2018, this is an example of what the schedule looked like. This will not change. You will still need to enter only the lease and description, the annual lease payment, the lease beginning date, and the lease ending date. That information that you loaded in on the AFR was then used to generate a schedule in the report, which was included in the unaudited supplementary information. This is an example of what it would have looked like. And it's showing the annual lease payment, the lease beginning date, lease ending date by activity. And it, again, was in the schedule in the section that followed this other information unaudited. And we've already talked about this in the independent auditor's report. We reference the schedule of leases and debt and state that the information in that schedule was not subject to the auditing procedure, and we are not expressing an opinion on it. This is how we did it through 2018. For 2019, this information is going to be again entered into Gateway next January and February. It will now be presented in an audited note to the financial statements. Again, we're putting an opinion on it. It will include a general description of the leasing arrangements and information regarding principal and interest requirements until maturity. The amortization information will come from your DLG debt management report. I'd like to point out that under GASB 87, remember GASB is the one that prescribes the financial accounting for governmental units, it is effective, and it is effective for reporting periods beginning after December 15th, 2019. That standard removed the distinction between operating and capital leases. The updated regulatory will reflect GASB 87, and all leases will be reported unless they are short-term, which is defined as 12 months or less. So you don't have to determine is it a capital or operating lease. If it's a lease and it's more than 12 months, you're going to report it. So here is an example of what the new lease note will look like for 2019 and subsequent years. It has all of the amortization information now, which it did not before. Again, we're pulling that from the debt management to capture that information. You do need to make sure that this information in this note is correct. The best way to do it is make sure you've put the correct information in the management, but do check it when you're going through the financial statements and make sure this is saying what it should say. Here's a checklist again for information you should have as you prepare your next annual financial report. Some of this, again, we're going to pull from the debt management report. But the information we're going to need is the general description of the lease arrangements, the name of the lessor, the lease beginning date, the lease ending date, the annual lease payment, complete debt management report information, and updated debt management report as needed. So if it changes, make those updated changes. Okay. As I already stated, the information has been shown as unaudited information. We did not test them. We didn't make sure they were accurate. We might, if we've come across it, have pointed out to you if we found something that was not, but we did not put an opinion on this. In order to put an opinion on the note, our field examiners will need to review the supporting information for the numbers you've entered. Although they may request additional information, the information as shown on this is the basic information they're going to be looking at. If there's something a little bit different, if there's something unique about that lease, there may be additional information they ask for. So they want the agreement itself, the lease agreement, the claims, and the supporting documents where you made your lease payments, your internal controls over the financial transaction reporting for making your lease payments. Are there any questions over the changes for debt and leases? Wow, okay. There's going to be some changes in the capital asset information. We're going to go over those now. The note regarding capital assets is actually going to be phased in, so there's going to be some changes for 2019 and some additional changes then in 2020. So hopefully it gives you more time to get the information gathered. Capital assets tend to be a little more complicated. You have always been required to account for your capital assets, even though you were not reporting them as an audited note in your financial statements. The Uniform Compliance Guidelines required you to have a capitalization policy. It's always been the responsibility of the fiscal officer to maintain capital asset records, to establish internal controls over recording and reporting those capital assets. We do have a prescribed form, which is a manual form. I don't know how many probably use it. You probably have a software that tracks it, or a database or something that maybe Excel. I'm not sure what everybody's using, but there is a manual form. The manual form is called the capital asset ledger. This is kind of an example of what it looks like. I don't know how easy it is to see up there. And it's asking you to record the date of purchase, a description of the asset, cost of the asset, estimated useful life, and columns to record disposal information. All of this information was broken down further by the types of capital assets owned. So we're looking at land, buildings, improvements other than buildings, etc. This is a pretty old form. It's been prescribed for quite a while. But we do realize most of you have some sort of software computerized version of that, and that's fine as long as you're collecting this information. When you did your AFR for 2018, you were asked whether your unit maintained records listing the types and values of your assets owned. You could answer no to this question, and you could still complete your annual financial report. You'd get a warning that you really should be keeping your capital asset records, but it wouldn't stop you from submitting. If you answered yes, which most of you probably did, then a capital asset schedule was generated for you to complete. So the schedule on the AFR in Gateway looked something like this. And this is the information it was asked. You're showing the ending balance information by class of asset for each government or enterprise activity. So what did you have in land? What did you have total in land, in buildings, in improvements other than buildings, your infrastructure, construction in progress, equipment? Then it generated a schedule that went into your actual audit report, although it's unaudited. The information entered in Gateway generated another schedule that was included in the report. It's an example of what it looked like. It was also included in the other information unaudited section, and we expressed no opinion on it. For 2019 financial statements, again, this is the information you're going to be putting in next January and February in 2020. Additional information will be required. You need to now report capital asset additions and reductions for the year, and that will show up in the audit report. For 2019, this information will still be shown as supplementary information, but we are going to apply audit procedures to this schedule. We will be testing internal controls over capital assets. So what does this mean for you? If your capital asset records are incomplete or not well documented, you do have time to fix it, to make sure you have good numbers, good documentation, and that you get your controls in place. So we're going to talk about the changes to Gateway for 2019 that's due in 2020, and we're going to look at the information you're going to need for audit. Overall, the format to the capital asset schedule is going to look something like this. The old schedule had the capital asset categories and then the ending balances. They were presented in columns. These will now be done in rows so that you can have your beginning balance, additions, reductions, and ending balances. The columns in blue represent the new requirements for 2019, which is going to be for capital asset activity for the year 2019. The ending capital asset balances from 2018 will roll forward to be your beginning balances for 2019. Should be automatic. However, we know glitches can happen, but you want to make sure those numbers are accurate. We're going to add those addition and reduction columns, so you need to put that information in. You will enter any purchases or disposals for the year by classification in total. So any land purchased, total amount of land purchased, or the total amount of land sold, down through that. The ending balance will automatically calculate with the following formula. Take that beginning balance, add any additions you've loaded in, remove any deduction or disposals, and come up with an ending balance. One of the things we will check during audit that you want to make sure is that ending balance should agree to your capital asset detail ledger. It should tie back to that. So to be ready for 2019 financial statements, start with the numbers that you've entered in the 2018 gateway, AFR, because those are the numbers that are going to roll over for 2019. Go back and look at them. If we had to fudge them a little bit, we want to correct them now. Here is a portion of the prescribed form for the capital asset ledger. You keep this form, although, again, you're probably doing software, but it should have the same functionality. Keep it by fund or department. The numbers on this form need to agree to the numbers entered into Gateway, so your records support what you're reporting. Again, you may keep the records in another way. You might have an Excel spreadsheet, you might have a software program, a database program that you're maintaining. Still need to go through whatever format you have and make sure that the information you're keeping is up to date. I would say disposals are probably the most problematic because the departments don't always tell you when they get rid of something. So you may be carrying it on your capital asset ledger when you don't have it anymore. You can print out the section, say for a department, and ask them to check it, to do an inventory. Do they still have this? Is there anything missing? Get you updated records. Anything that the county no longer owns needs to be removed. If you find that your ending balances for 2018 were not correct after you go through these procedures, and so you wanted to correct for the 2019, be sure and document the changes you need to have made and have that available for audit. Because we are putting an opinion on that, we will be auditing the beginning balance information, even though that's rolling over from another year. So they're going to be asking you questions about that and any changes or anything that you've made. If it's material, it may require some additional note disclosures. So make sure you have that information documented for them. Once that beginning balance is tested, they're going to start looking at your purchases through the year. Basically, looking to make sure you captured every asset that was above your capitalization threshold, that you didn't capture any that were below, that everything you posted was actually something that was purchased by the county. So thinking about those procedures, start thinking about ideas that you can put in place to get some control over your capital assets if you don't already have them in place. If you are a county, I know there's some, that does not have good capital asset records, and you need some additional info, this is a kind of a high level, you need to let us know. We will glad to work with you, Ricky and I, from now to the end of the year to come up with maybe some ideas, some procedures, some ways to go forward with this. So be sure and let us know. If you have not kept up your capital asset records, you are going to have more work than a county that has kept them up. You're going to have to be looking back through purchases, you know, some of your reports for prior years, inventories, like I said, with your departments, what do you currently have? There are places you can go that carry some of this information. Your highways have probably done a really, really good job of keeping the infrastructure information up. I really hope they have, but because of LTAP and some of the information in the highway report, they probably have a pretty good handle on that, and that's a large part of your capital assets. Building and lands, you hope you've really got that. So when you're looking at equipment above your capitalization threshold, if you need to look at purchases above that, insurance, what are you insuring? It's your title file, you know, how many dump trucks do you own? Start gathering that information. if you are not keeping them up to date, it is going to be a lot of work. I can't sugarcoat that. I'm glad to try to, give you some guidelines to go through, but you need to start getting this. As I said, reductions is often problematic. I have audited capital asset records where there are pieces of equipment that they haven't seen for years. They just never got them removed. Those are more probably going to be caught by an inventory than anything else. Trying to determine when you disposed of an asset can be problematic. So you might have to check back to records. If you traded it in, it might be on the financial with the claim where you made the purchase of the new piece of equipment. There might be information in your minutes. Where did they approve? If it was a large purchase, when was it approved? And what did they say to do? Was it you're going to trade in? What was the whole scale of the process? But you're probably going to rely pretty heavily on your department heads to get you a current inventory of what they have and when they got rid of something. And going forward, you want to set up some controls. You want to set up some procedures. I've seen different things done. In some units, they will, there's a form. Anytime they do a purchase, they do a capital asset form that has to be attached to that gives the information to add that information to the capital asset record. Some softwares will flag anything over your capitalization threshold so that you can look at and do a printout and look at that and see what needs to be. Smaller units sometimes they just put all the claims above the capital, any purchase above the capital asset threshold in a separate file and go through them at the end of the year to make sure they've picked all of them up. There is no one way or right way to do it, but you need to start getting some idea, depending on how active your county is, how much you're purchasing, that you start getting this information flowing through the auditor's office so that you have it. The ending balance will calculate automatically. But again, double check that number because that's got to tie back to that capital asset ledger you're maintaining in whatever form you're maintaining it. And this is something that we are going to audit for. That's one of the first things we're going to look at when we're doing a capital asset audit. Does this number tie to this number? So do that beforehand and make sure you document any variances or research any variances and get them corrected. Okay, so we're going to go through some frequently asked questions. Oh, that worked. Okay, so we need to talk about getting there. The major portion of our discussion in the next segment will be how to gain an understanding of your capital asset reporting, implement policies and procedures, and to maintain that capital asset ledger. There is information in the Accounting and Uniform Compliance Guideline Manual and bulletins, so review those articles. I've included a slide in here that shows where those are available. There are other sources of information. GFOA, Government Finance Officers Association, has best practices. They have a website. You can go to there, get some additional information. So a lot of questions that we receive. First of all, what is a capital asset? And we've kind of talked around it all this time, but the term capital asset is used to describe assets that are used in operations that have initial useful lives extending beyond a single reporting period. For you, that's 1 year. They are broken down into classes: land, infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, construction in progress, You only need to report the capital assets that meet the criteria set out in your capitalization policy. So first thing, make sure you've got that capitalization policy. Your governing board, your commissioners, should have a written policy concerning capital asset that includes at a minimum the threshold of at which an item is considered a capital asset. That is going to vary from county to county, from unit to unit, depending on your size. And it's the number that your governing board is comfortable with. Since it determines what gets included on your capital asset reporting, it needs to be significant and material to your financial statements. You do not want to be capitalizing every single purchase that you made, regardless of the dollar value, because you will wear yourselves out and you won't have much to show for it, other than all your hair's been pulled out. We are often asked, what is a good threshold amount? We can't really tell you. What's good for Orange County is not going to be the same number for Marion County. There is some authoritative source materials that you can consider, like GFOA's website. They recommend $5,000. This is your decision. These are just recommendations. They recommend $5,000. Do keep in mind, if you're purchasing money or purchasing assets with federal grants, look at the grant information, because they will have a dollar amount that you need to record if it's federal. You may want a higher threshold. You might want 10,000. It's what is important to you or to your county to keep track of. Remember also that you are keeping track of all of your assets. You may not be capitalizing them, but you're tracking them. So if you have significant but less than your capitalization threshold, you will have some sort of inventory controls. I don't know if you can see this. This is the state's inventory control on my laptop. It is not part of our capital assets, but believe me, they come around at least once every 2 years and say, let's see it. Do you have it? Is it the same serial number we have? That way they're tracking the inventory of this. They're still controlling it, but they don't have to keep track of every $2,000 laptop or every, smaller electronic equipment, iPads, things like that you're buying that may not be your capitalization threshold. You just want to keep track of. So that's a different process, and that's not what we're talking here. You can also adopt a capitalization threshold for different categories. Land should be anything above 0. But infrastructure might have a higher capitalization threshold than equipment. You can set one for each if it's at your decision to do so. The capitalization policy will be uploaded into Gateway as part of your 2019 AFR. Sure.
For the land value, do we use the purchase price or can we use the assessed value?
It's a historical cost.
Okay.
And here we go, historical cost. How do we value our capital assets? So capital assets that are acquired either through purchase or construction should be reported at historical cost. What did it cost at the time it was purchased or constructed? So if your unit bought land 5 years ago for a park and it cost $30,000, that's what you're going to carry it. And maybe that area has been way developed and now you could sell it for $100. It doesn't matter. You paid $30, that's what you're going to show. It does matter, but not for capitalization policies. So if you do not have the cost information for assets that you already own, there are options. One approach is to determine what is the market value for a particular type of asset at the time it was acquired. You might be able to find that information, depending on what it is, on claims at the time, old records that you have. There might be able to go online and Google what it cost in 1982. You might have old catalogs. I hope not from that long ago, but you might. The second approach is to determine what it would cost to purchase or acquire that asset new today, and then restate that amount in acquisition year dollars. For example, if you have a building that you purchased in 1930, you know what the replacement cost is because you had to get that for your insurance purposes. You can apply a consumer price index factor to the current market value or the replacement cost amount to estimate the historical cost. Okay, we do have a schedule in our bulletins that show that cost price index. And I think I wrote it down. You will find the schedule in the June 2018 County Bulletin. So if you want it, if you don't remember that, call me. This may require more research if you really have not kept this up and you're trying to go back and reestablish these costs. You can go back to your county recorder records, assessor records, if it's property. If you don't know the amount and you need to document current value of the property, make sure you document where your source is, how you applied that factor to it. So if you used, your insurance or an appraisal or what you used to get that value, and then how you determined that historical cost. Infrastructure can be difficult. I'm hoping for counties that most of this is captured in your highway because your roads and your streets make up a big part of that. Bridges, drainage systems, if you have a stormwater maintenance system. In Gatsby 34, which was back in 2009, it did have in the guidance on that, if determining the actual historical cost of general infrastructure assets is not practical, because of inadequate records, government should report the estimated historical cost for major general infrastructure assets that were acquired or significantly reconstructed or that received significant improvements in fiscal years after June 30th, 1980. So remember that. About replacement. Construction work in progress. If you don't have an ongoing capital project, this may not be a big deal, but if you're doing a lot of construction projects in your county, this can be a really big deal. This is where you acquire all of the information, the cost information, until that asset is put into service. So you're capitalizing it instead of expensing it, you're keeping track of it. If it takes a year to build, you're going to acquire all that information for the year. Keep it in construction in progress until you move it into the category that it's going into, whether it's infrastructure or a building, new jail, okay? It's important that you track those claims so that you're tracking all of that information so that you have the cost information together. If it's taking a period of time to do that, a little foresight going in where you're making sure you flag all of the claims associated with those projects will help you get that information together. Machinery, equipment, and vehicles, usually that information isn't hard to come by. A lot of equipment doesn't last, your police cars, do they even last a year? I don't know. So you probably have, records on that. Okay, on the prescribed form, it has a column for you to list the estimated useful life of the asset. This is important information when we're going to start calculating depreciation, which is not next year. Gaap requires the capital assets be depreciated, which means that the historical cost is allocated over its useful life. So we're taking that expense a chunk at a time.
You got a question? Sorry, I can't.
The question I have is like our sheriff's department who turns in, say he went and bought 20 tasers at $300 a piece. So therefore it goes over our threshold as a one-time purchase.
No.
But do we not put those
No.
on then?
It's the individual cost of each item.
Okay,
So
that's what
it doesn't matter if he buys 50 of them. If the original costed $3,000 and that's below your threshold, you will not capitalize those. Track them,
Track 'em
but
inventory.
not capitalize them. So even though you're not going to be calculating depreciation in 2019, we ask that you start putting in that estimated useful life because we need that information going forward, so start gathering that up now. Usually the number you assign as the estimated useful life would have some basis on your experience with that type of asset. Obviously, dump trucks probably last longer than a sheriff's police car that are used in high-speed chases. There are available resources on the internet which can provide a reasonable basis for estimated useful lives assigned to an asset. We're just going to look at these to see if what you're assigning is reasonable and it's in compliance with your policy, your capitalization policy. So you need a checklist here for the information you're going to need before you sit down and do your 2019 AFR. You have to have the capitalization policy. That is step number 1. You're going to have to get your board on that if they have not already established that. You need to make sure you are maintaining your capital assets ledger, whether you're using the prescribed form or software or whatever you're doing. You're going to be able to identify the capital assets by activity, by major class. Confirm your beginning balances. Report your additions in 2019. Make sure you have all your reductions in 2019. Compare your ending balance to your capital asset ledger to make sure they tie. Document any basis or calculation or work you've done for determining historical costs for value and estimated useful life. Make sure you start establishing those controls over the capital assets. Where are we at on time?
We're starting to run out.
I exceeded my usefulness here.
Hey, we got a question, though.
When you talk about the board, you're indicating for your capitalization policy, a lot of these may already be in effect and some of us may not know it. Would you agree with that? Since we have a lot of new auditors.
Yeah, you need to check and see if you have a capitalization policy. It should have been passed back when we were doing GASB 34, so you may have it, yes.
And when you say passed by your commissioners, correct?
Yes.
Thank you.